we can potentially make a lot more money than what we're doing right now by employing risk management, which is not in this study. We can also make more money by putting a pair of human eyes on it. Okay, when a trade comes up, like in this case, a buy, I can see other indicators and I can look at it, or I can know what's going on in the market, and I might say, you know what, I don't want to take this trade at this time. Or I can say this is a stock that has not shown a tendency to trend well. This is what I would call a good trend. This is what I would call a sloppy trend. It's going sideways. So if a stock shows a past history of trending well, that's a trade I'd be interested in taking. In our test, anytime our rule is met, no matter what stock it is, it takes the trade. So we can potentially outperform on that front as well. Now we're going to look at the results. What we have are three things. First, our watch list equity line. This is our trading strategy. Over here we have watch list buy and hold line. Our Wall Street has sold the idea over the last 30 or 40 or 50 years that you hold for the long run and you'll be okay. Well, if you look at the performance of the S&P 500 over the last 5 years, you would have lost money. If you go back even further and you look at the performance over the last 10 years, you would have lost almost 4 times as much money. So the idea that they've been selling is a false notion, but it's the only way that they can keep you in their fund and collect management fees from you. They don't lose money when the market goes down. You lose the money. They collect money in management fees. This is our strategy. This is buying all 500 S&P stocks at September 1st, 2008 and holding them, and selling them at September 1st, 2009. And this is the watch list equity over here compared to the buy and hold strategy over here. So how did the watch list equity, our strategy, do against buy and hold? Real quick, let me clear this up. The test starts, as you can see, both tests start with a minimum equity of $100. And what happens is, in our strategy, anytime that we have a signal that says buy or says sell, this $100 is equally divided among all open trades. When we have the watch list buy and hold, it takes the $100 and it equally divides it among all 500 S&P stocks, and it holds throughout that entire period. And as you can see, your $100 would be worth 81. So you would have had a loss. With our strategy on the S&P 500, which is not at all the best watch list for us to use for this system, but I want to show you I'm not overfitting or customizing, you can see that we actually made a gain. I am going to show you very specifically what the numbers are. Over here you can see our strategy tested over the last year in the S&P 500. Started with $100 and our closing equity is $150. So we made 50% on top of our money. Now, to do 10% in a mutual fund is considered good performance. 10% above the market, which would mean that you would still be losing money, but you would be paying for that performance. You beat the market by 10%, even though you still lost money. We beat the market by a factor of nearly 2 to 1. Over here you can see 1.9. That means in a market that has been going down fairly consistently for the last year, we not only beat the market, but we made money. And the kind of money we made, the performance, that 50% that we increased, typically a hedge fund manager would be paid anywhere between 20 and 40% of the profits on that, as well as a management fee. So this kind of performance is exceptional. And the watch list that we're using is really not an ideal watch list. Okay, what I'm going to do right now is I'm going to show you a test. Okay, we're going to do a new test. We're going to change our watch list to the type of watch list that we will be using. Okay, and these are the stocks, and we're going to change our rules. Instead of 1 year, we're going to test this since September of 2000. 9 is what we're going to use. So this is a 9-year test. Okay, we have our rules: when to buy, when to sell. We have our watch list and our time period, and we are going to simply test these stocks. You can see we test them very quickly. We've tested over 72,000, almost 73,000 conditions in 5.22 seconds. And we are going to look at our equity line. And as you can see, 9 years to date. We're going way back here. And like I told you, we start with $100. This is our watch list, which is to say our trading system. So every time we have an open trade, that $100 is split among all open trades. The watch list buy and hold simply at the very beginning buys all of the stocks, splits up the $100, and we get our performance. If we go ahead and zoom back in and we look at our performance, we have $289,000 that this system generated versus the buy and hold of $394. Started with $100, $394 at the end of 9 years, and $289,000 on our system. Our system outperformed buy and hold by a margin of 732 to 1. Pretty impressive. So I want to show you a couple other things. Number one, let's just take a look back and let's see what some of our trades might have looked like. There's 9 years. The gray shows the beginning of the test period. You can see we caught a nice uptrend here. We made a little money on a short, caught a nice uptrend here. We made good money when the market was going down. We caught a very nice uptrend here. We made a little bit of money on the shorts. We made a lot of money on this short sale. We made some money on this short sale, and we've made money going up. Now the market and most funds, all mutual funds, can only make money going up. They cannot profit from the short sales going down like we can. And what else can we do to further enhance our gains? What I've done is changed programs to Telechart. Our last one was Stock Finder. That's where I test everything, and this is generally where I trade. And again, we're looking at a price chart of SPY, which is an ETF. It basically tracks the exact performance of the S&P 500, except you don't have to buy all 500 stocks. You simply buy the SPY and you get the performance of all 500 stocks. Again, this red line is our 50-day moving average of value. This blue line is our 200-day moving average of value. We're going to look back a little bit and just see how this market has performed. You can see since about October of 2007, we've been in a bear market. We're still in a bear market. This is a bear market rally. I expect that the market will probably go down to retest the lows that are over here. But my opinion is of no consequence. It's what the market does. And that's the reason that I developed this trading system, is to largely take my personal opinion out of it and to replace that with objective analysis. Not what we think the market might do, but what the market actually is doing. Remember, to get a trade signal, we need the market to be above or below that channel for 2 consecutive days, and the next day we have our signal. We also can employ risk management strategies. We can also put a human eye on it, which will help us out tremendously.